Hello everyone, Philip from BlackBull Markets, and we're back with another Whiteboards Wizards video. This one will be taking you through the first rule of trading, or rather I believe the most important part of trading is to identify what part of the market you're in. So we'll be going through three different types of markets. We've got our normal markets, the volatile markets, and the quiet market. So quickly a recap on these. The normal market is just the market proceeding as is normal, taking its normal course. Then we have a volatile market. This is usually during big news events, lots of volume, lots of orders coming into the market. And then obviously the quiet market, no volume. This is usually when the market's like a rollover time period, or when there's sort of nothing really happening in the market, usually during bank holidays as well in other countries. So sort of starting off with the easiest way to identify the volume in the market is the size of your candle. So quickly take you through just a normal bullish candles example. So obviously we're going to have our normal candle, which usually just looks anything along this sort of line. Obviously open, we've got to open, our close, our low and our high. So that's just usually the look of a normal candle. The bigger the body of the candle is, usually the more volume there is in the market. So obviously if we have a really big candle, and also they accompany without any wick. So smaller the wicks, the bigger the body of the candle, the more volume. Now again, in a quiet market, there won't be a lot of movement. We'll usually see something along the lines of a doji, any sort of hammer or hanging man, either color as well. So, either direction. So this is sort of the easiest way to identify the market. So usually normal markets, this is a very, not, you would say volatile, but lots of volume in the market, and this is very quiet in the market. So these are sort of the ones we look at to identify what part of the market we're in. So now when you go ahead and look at the smaller version, so we'll take you through the first step. So obviously the bull market we just talked about, the normal bull market. So easiest one is just to identify a normal candle. So you will find this like on your weekly, depending on your strategy. If you're more of a day trader, you will look at a daily sort of candle, 4-hourly candle as well. More swing trader, you'll be on your monthly or your weekly, you'll see this. Now, moving into that, what you want to see is you want to sort of look for a normal sort of path of the market. So what we'll usually have around this section is we'll have something along the lines of the market forming, going up, and then we'll see sort of just a correction, and then continuing up in that trend. And we'll see sort of the body being formed depending on how long this is. So we have this section, and now if we're coming to the open, high, and the close. So the close and the high, apologies, we'll see a nice pullback or a correction in the market, and we'll see it continue. So this is usually the normal sort of process of markets. We can see our nice close over here, with its high as well. So we'll see that pullback. Usually this is where your head and shoulders start to form. So that's a very simple way of this. The easiest way, or the easiest market to trade it is your normal market. So obviously this is vice versa for your bear trend, just the other way around, going to the downside. Now a sideways market is a little bit more difficult to identify in a sort of a normal trend. What we'll see is a couple of also smaller body candles. So we could see something like just a general candle size over here. This will if you drop down to your lower time frame. So this will be more on a daily time frame you'll see usually, and we'll see another candle sort of coming closed here. So the market just generally moves in a sideways sort of consolidation between two parallel lines. So that's sort of the type we'll look for. Now obviously if you move on to the higher time, so the higher time frames, so if this was your daily, you look on the monthly, you will obviously see a very quiet market. So you'll see something like this on your weekly or your monthly. When you move to the daily, this is something you'd see. Now obviously the lower the time frame you go to, the more normal the market will look. So if you look on this and your monthly, your daily, and if you look on your 30-minute or your 15-minute, you will obviously see a market that's sort of, it's got these nice long legs you can push into. So that's a normal market. So keeping in mind every time you drop down to a time frame, the moves will be bigger. So be very aware of when you do trade that. So that's just the basics of our normal market. That's sort of the things you want to identify when you do trade it. Now, like I said, that'll be the easiest time to trade in a market is when it's behaving as per normal. Now, volatile, this can be extremely difficult if you don't have the right risk management. Now, a lot of people, like I said, this happens during news events. So a lot of people try and find a news event to spark a whole new trend, which is very unlikely. So we have covered this in the previous video, but I'll briefly take you through it again. So during a news event, for example, we have NFP coming this Friday, which is the biggest news event of for Forex trading. You know, lots of movement in the US dollar, in the gold as well. So we will see, for example, if we have a normal market movement, so we just have a normal sort of structure in the market. And now what we're looking for is the NFP will start to either do something, depending on if it's good or bad for the dollar. We will see a lot of times we have this sort of resistance created here, for example, and then we see the candle open and we have that massive push to the upside. So the candle really pushes to a strong upside. Now a lot of times people take this, they'll put their entry here and their stop loss just below here. And what they don't think about is this is a very volatile market. So lots of orders come in, people are scared, they don't know how to react, especially new traders. This is just going to be a big spike. So what happens the majority of the time, the market creates that sort of initial push to the upside based on the event, or even prior to the news event as people start pricing in their orders. This is what we call FOMO, so they're scared of missing out, fear of missing out rather, and they put their orders in, and as this market pushes up, people panic, or you know, they close their profits, and then the market starts to push down. And what we usually see is a big candle with a wick that goes to the upside. And a lot of people get burnt here, and then the market will go from here and then just go straight back to its normal sort of behavior, or as to what it was. So this can sometimes even signify a reversal as it rejects that sort of resistance area. Now, like I said, a volatile market is quite difficult to trade for, especially as swing traders. Swing traders are not really fussed at all about a volatile market because it creates that short initial explosive movement in the market. Mostly for scalpers or your day traders prefer to trade during the volatile times. This is also going to happen during your opens or your session closes. So if you are going to be a scalper or a day trader, I would really try and focus on these things, really sort of understand how a market moves. Don't switch between too many markets, try and focus on one, because they all have their own difference, their each personality. So really do focus on this. Obviously, if you, like I said, a swing trader, focus on this. Now the market we want to avoid is a quiet market, regardless if you're a swing trader or a scalper. Now swing traders are not really too fussed about this, but it is also a danger zone for them because the market is uncertain, not really sure what can happen, and you won't have a lot of movement. Now keeping in mind, if you're a swing trader, you have swaps coming into account when you start trading. So if the market is quiet, for example, I'll show you a quick trade. Now for a swing trader, we're looking for that move to the downside. So for example, we have this head and shoulders pattern sort of forming here, and what we're looking for is a push to the downside to fill the shoulder over here potentially. So we have the rejection, we have our indications, whether it's your indicator, an event that said price are going to go bad, any sort of market structure or macroeconomics. And then what happens is, if the market is extremely quiet here, you could enter that trade with your sell and your stop loss just above here. Now if the market is extremely quiet, we won't see a lot of movement here. Now as you go through your days, as you wait overnight for this trade, your swaps will start to kick in. So it'll keep going, keep going, keep going. You'll stay here at break even, while on the back end your swap will make your account go negative. So just keep that in mind. So that's the one thing about a swing trader who wants to trade in a quiet market. You need to know about your swaps. So please be aware of that. We actually have a video on that, how to calculate your swap. So make sure to check that one out. Now, as for a scalper or a day trader, obviously if there's no movement in the market, there's nothing you can do. So quickly show you just what, like I mentioned in the start, I already showed you what it looks like, what a quiet market does look like. So they'll pretty much look the same on every day. So if we have a look on the, say, the daily time frame, we'll obviously see a doji, wherever you're from. So we can see this on the daily time frame. Now if we move down to the 4-hourly time frame, this will obviously consist of a couple of candles. So we'll see something, just small candles rejecting with their wicks. You know, we'll have a really sort of messy look. And then, well, yeah, there's one more missing. So we'll see something like a nice sideways moving market. This wick might go a little bit longer, this one might go a bit up to create that doji. So we have this middle section being that over here. Now, again, we'll see the similar sort of structure as we go down the time frames. Obviously, if you go to your 50-minute, you'll see something where the market kind of does this. So it's going to be a really, really sort of ugly market. We want to avoid it. So the first thing you want to look at, especially if you're a trader, a day trader, if there's no space for the market to move into, there's no trade. What you want to see ideally is a candle where you have a resistance and they support, we can at least have a bit of a range to trade into if you're that sort of day trader. So that's just a quick explanation of the market. Now, obviously there's no movement on the market, so there's nowhere for you to go to, so you don't know whether the market's going to do. So the best thing to do is just wait for a market to resume either its normal trend or wait for that news event, because a lot of times during a quiet market, especially if you know your Elliott wave, you obviously have your waves 1, 2, 3, and your 4, it tends to be a triangle. Now, if you have studied a bit of Elliott wave, you do know usually just before the end of a triangle there is a news event that's going to release, because people are anticipating something, so orders are coming in, the volume's getting less, and then that news event where we just go from quiet to volatile gives us that final spike to the upside to create that wave 5, and that obviously signifies the market going back. Now we talked about that previously, where you get that initial spike, and it could be the potential for a turnaround. So now we've got our 5 waves, and we can go into our correction for our A, B, C, also creating us a nice head and shoulders. So that is the basics of, it's a bit of a long video, but that's sort of the way to identify what market you're in, what markets you want to trade, what markets you don't want to trade. So obviously normal, any trader can trade here. Volatile, you can be your day traders, quiet, no one wants to trade. So hope you guys did like it. If you did, give us that thumbs up, click the subscribe button, followed by the bell icon. Want to get in touch with us, please do so. Email us at support@blackbullmarkets.com. Stay tuned, trade safe.